Most people probably think about mortgages and just think about fixed term or tracker mortgages, residential or buy to let, but there's a whole world of hidden products that could save you thousands of pounds. You may not know about some of the niche mortgage products. So today I'm going to go through a lot of the mortgage products that you're probably unfamiliar with. So buy for university. This is a mortgage that you can get if you have a young person going to university. So instead of leaving university with debt, they could actually leave university with a property. Joint borrower, sole proprietor. Fantastic for boosting your affordability if you're a young couple and you have a parent who can help you purchase the property by adding their income to the purchase. Residential interest only. Most people know that you can do interest only on a buy to let property, but some people don't realize that you can do interest only on a residential property. Specialist mortgages. So if you have credit issues, if you've missed payments, have CCJs, defaults, you may have ruled yourself out and thought you can't get a mortgage, but you actually can. Consumer buy to let. So a consumer buy to let mortgage is a mortgage usually used when you have a couple who both have their own individual properties. They come together, get married, and decide that they're going to let one of the properties out. So that would be a consumer buy to let mortgage. HELOC, so home equity line of credit, an exciting product that a lot of people don't know about, don't think is in the UK, but is actually available to them. Expat mortgages. Maybe you have a property, you've moved away from the UK and you're living in another country, and you decide that you either need to remortgage or you want to buy another property in the UK while living abroad. Expat mortgages are fantastic. There are lots of lenders that do them, but the criteria can be a bit tricky. So you want to make sure that you speak to a mortgage broker. Skilled worker visas. Skilled worker visas. A lot of people in the skilled worker community are told you can't get a mortgage in the UK because you don't have a UK passport or indefinite leave to remain. It's not true. I do mortgages for skilled worker visa holders pretty much every day. There are great products out there. So make sure you contact me that I can help you if you have a skilled worker visa. And self-employed. There's lots of myths around getting a mortgage if you are self-employed, particularly if you don't have 3 years worth of SA 302. I can help with all of those things. I'm going to talk through each of them in a level of detail, and make sure you watch all the way to the end because I talk through my £0 broker fee offer. So £0 broker fee offer. So if we don't get you a mortgage offer, you don't pay a broker fee. My name is Anthony Lindsay, and I've been in finance for over 30 years. There are lots of mortgage products that are out there that maybe an inexperienced mortgage broker won't know and won't be able to share with you as a client. So I'm going to go through some products and some mortgages that maybe you didn't know about. Make sure you watch until the end. I'll cover them off briefly, but I do have videos for pretty much every one of these products. So let's just start with a residential interest only mortgage. What is a residential interest only mortgage? Most people know that if you're buying a buy to let property, you can get an interest only mortgage. But what a lot of people don't realize is you can also get a residential interest only mortgage. Or if you're an older person who's retired, you can get a later life interest only mortgage. So you pay only the interest each month, not the capital. So that means each month the repayments are going to be a lot lower because you're only paying the interest. It's usually used for higher earners and short-term flexibility. So people that are at the beginning of their career and know that they'll be making more money in the future so that when they remortgage, they can remortgage onto a repayment mortgage. But it's a great consideration if you need that short-term flexibility in order to purchase the property, as long as you have a very solid exit strategy. So you have to make sure that you show that you have a solid exit strategy and a good repayment plan. Quite often, they will require a higher deposit and there are stricter lenders' criteria. So in a nutshell, that's a residential interest only mortgage, make sure that you speak to your mortgage broker and understand the implications of only paying interest on your mortgage. Buy for University. This is a product that a lot of mortgage brokers don't know about, a lot of consumers don't know about, and it's a very exciting product. It can help break the myth about generation rent and how difficult it is for young people to get mortgages. The Buy for University product allows parents to support their kids in buying a property as they are in university. It's cheaper than renting and can be an investment. So when they finish university, they actually have a product that they can switch over into a buy to let mortgage. The child can be the co owner and the tenant. So, in most cases, the child does have to reside in the property. They could rent out some of the rooms. And the mortgage structure is different than a standard buy to let. So, some of the criteria is easier, some of the criteria is a little bit harder. So, the student must live in the property. So, you could get a 3-bedroom house. The student lives in 1 bedroom and rents out the other 2. Typically, the parents go on the mortgage as a joint borrower, sole proprietor. So the parents are on the mortgage, but they don't necessarily own the property as far as the deeds are concerned. Standard rental income may not apply. So the lender's going to look at what you could reasonably rent out the rooms for. And you are, in most cases, going to need an AST on the property that also names the young person. Deposits are a lot higher, and the deposit structure is a lot different than standard deposits. Sometimes it will require a second charge on the parent's home. So this product is really only suitable if you have a parent or parents who own their own property, have a very low mortgage outstanding on it, and are able to do a second charge on their property. The Buy for University mortgage is a niche product, and a lot of mortgage brokers don't know about it, and many lenders don't offer it. But if this is a good fit for you, make sure you speak to your mortgage broker. If you don't have one, contact me. Specialist lenders. So, specialist lenders exist to help people who cannot get mortgages with the standard high street products. So, a specialist lender is going to underwrite the mortgage very differently. It's designed for those with poor credit history. So you've had late payments, missed payments, CCJs, defaults, and in some cases, even repossessions. It can help anyone rebuild their credit that they can still buy a home. And there's more options than most high street banks. The great thing that I like to see happen is someone who thought they could not get a mortgage come to me. I place them with a specialist lender. Now, the fact and the reality is the interest rates may be a little bit higher. However, if we get you a short term or the appropriate term for you, and you pay well, you put distance between when you had the credit issues and this new product. By the end of the first term, when you are ready to remortgage, you could possibly be able to remortgage with one of the high street lenders. Keep in mind, it's usually going to have higher interest rates, and proof of recovery since the time you had the issues is required. So what that means is you had a bump in your finances. Maybe, you were off work due to sickness or illness. You fell behind in payments. You got CCJs or defaults. What the specialist lender is going to want and need to see is that there's some distance between that and when you apply for the mortgage. So this is something that you want to speak to your mortgage broker about early, that they can put a plan together for you, that you can get that mortgage. So don't rule yourself out. Specialist lenders are there to help people that aren't vanilla clients and have had issues with their finances in the past. Joint Borrower Sole Proprietor, or JBSP. Great product. It's the engine behind a lot of the specialist products that I've talked about and will talk about. So essentially, a joint borrower, sole proprietor mortgage boosts the affordability by adding income from a family member. Some lenders will require that that family member is a blood relative. Some lenders will allow a friend or someone that's not a family member to go on the mortgage. Only one person goes on the property title. So although the other people are on the mortgage, they don't have a legal right to the property. Useful for first-time buyers priced out on income. So if you're falling a little bit short and you need that additional income, you can use a joint borrower sole proprietor mortgage, but make sure that you have the conversation with the person that you're doing the mortgage with, that they understand that they don't have any legal rights to the property. It also connects you with them on the credit file, as well as the fact that if you don't make the payments, they will have to make the payments. So the non-owner's income must be provable. So it's the same criteria as with any mortgage. You're going to need to provide pay slips and statements and ID and credit references, etc. Each person on the application is going to need to be able to qualify for that for the mortgage, and the mortgage application is based on the worst person's profile. So the lender's going to check all parties' credit. Affordability is based on the combined incomes. Non-owner doesn't acquire legal ownership. Great product if you have a parent who is older, has equity in their property, or maybe has already paid off their mortgage, therefore they have low outgoings. If you have a friend or family member who has a high income and they want to help you purchase your property, just make sure you have a solid exit strategy that when you go to remortgage, you no longer need them on the mortgage. A home equity line of credit, a HELOC. A lot of influencers online from America talk about this HELOC. Many people in the UK don't realize that HELOC loans are available in the UK. So a HELOC is kind of like using the equity in your home like a credit card. It's a flexible credit facility secured on your home. So it is a second charge on your home. You borrow and repay and reborrow as needed. It's a revolving line of credit, unlike a personal loan where you would get a lump sum, pay a fixed amount every month. This gives you a revolving line of credit that you can use, repay, and you only pay interest on the amount that you use. It's great for ongoing projects. I have a whole video about HELOC loans. Make sure you check that out. Make sure you like, subscribe, and make sure that you comment on this video. So some of the criteria for a home equity line of credit or HELOC. You need to have equity in your property. So this product is suitable in most cases for older people who have 40% or more equity in their home. They have low outgoings. And a key thing is you must have good credit. This is not a product that is suitable if you have bad credit. Interest rates can be variable. So, like a credit card, the interest rates can vary, and it's not widely available in the UK, but it is available in the UK. It's somewhat of a complex product, so make sure you're dealing with a mortgage broker who understands HELOCs, has explored other opportunities, and that you understand that failure to make repayments on your HELOC or even on your mortgage could result in your home being repossessed. As a reminder, I don't make these videos to give financial, legal, or tax advice, or to replace speaking to a qualified professional who understands your circumstances. Consumer buy to let. What is a consumer buy to let? Most people have never heard of it. So, a consumer buy to let is for landlords who didn't choose to become landlords. So, usually it's a couple, both of them own a home, they come together, they get married, they decide they're going to let one of the properties out. It's not a standard buy to let, because a standard buy to let would be a buy to let that is purchased with the view of renting out. This is a property that you used to live in and you now want to rent out. So there's more consumer protection built in than a standard buy to let mortgage. Some of the criteria for a consumer buy to let: property must not be purchased purely as an investment. So you probably already had the property, maybe you inherited the property and you now need a mortgage on it to rent it out. The borrower must not be a professional landlord. This is not a property portfolio product. It's an accidental landlord, someone who had a property and now needs to rent it out. Affordability checked, more like a residential mortgage. So unlike a standard buy-to-let mortgage, where when they're doing the affordability checks, they look at how much rent that property can bring in versus what the mortgage is. With a consumer buy to let, it's viewed more like a residential property. So there will be some affordability hurdles to get over. Make sure you speak to your mortgage broker and make sure you, if you need it, you get independent legal advice when doing any complex mortgage or financial item. Expat mortgages. So you lived in the UK, maybe you were born in the UK and you've decided to work abroad, but you have a property in the UK or want to purchase a property in the UK. So you do have some ties to the UK. Maybe you have a UK passport still, but you're living abroad. So this is for UK nationals living abroad wanting UK property. It's useful for investment or family use. It's specialist lenders, and there are people that focus just on expat mortgages. So if you need an expat mortgage, so you're living in the US or you're living in Canada or you're living in Ghana and you want to purchase property in the UK, it's not going to be a standard mortgage and the criteria is going to be quite different. So you want to start having the conversation before you're ready to pull the trigger. You're going to need proof of the overseas income. Primarily, the lenders like to see bigger multinational companies, not independent, small mom and pop companies. However, you could still be able to prove your income. It just might be a little bit more difficult if you're not working for an internationally recognized brand. The currency exchange risk. So some currencies are more volatile than others. So even if you, let's just say, had a $90,000 income, so $90,000 a year in income, because of the changes in the exchange rate, they may not calculate it based on that 90,000 because exchange rates can change. They'll usually want a larger deposit, probably about 25%. So if you already have a home in the UK that was already a buy to let, that shouldn't be a problem because most buy to let properties would have required a 25% deposit anyway. And the lender may want UK banking links. So they do want to see that you still have a UK credit footprint, maybe bank accounts. But if you already had the existing property, probably the rent payment was paid into a UK bank account anyway. But this is something that you want to speak to someone in advance. Don't wait until you're ready to pull the trigger to start looking at expat mortgages because there's some things that you're going to want to have in place. There are limited lenders that do it, and you need a skilled mortgage broker who's dealt with this before and knows which lenders to go with, knows which countries are sanctioned, know which companies are going to be easy fits for the lender to match the criteria. So that's expat mortgages. Skilled worker visas, skilled worker visas. A lot of people in the skilled worker community tell each other that you can't get a mortgage unless you have indefinite leave to remain or you've been in the country for 3 years, or some people just tell each other that they can't get a mortgage. I do mortgages for people holding skilled worker visas pretty much every day. These are mortgages for non UK nationals on skilled worker visas. It's a huge community. We have a lot of professionals that come to work in the UK and have tier 2 or skilled worker visas. It's an expanding area of lending in the UK because the UK is seeking overseas talent. You have some cultures that there's a lot of skilled worker visa holders in the UK and they want to buy their first property. Many wrongly believe that they can't get a mortgage, but I'm here to tell you, you absolutely can. So, what's the criteria? You must show a valid visa and length of stay. For many lenders, you'll need to have been in the country at least 12 months, and you'll need to generate a share code to give it to your mortgage advisor that you can demonstrate how long you've been in the UK and how long you have left on your visa. A minimum 12 months in the UK is preferred, but some will do from day one. Often you need a higher deposit, so around 10%, but I can get you with a lender that will allow you to do a 5% deposit. I would caution you though, you want to make sure that the savings or the money that you're using for your deposit has been built up through employment. So it's not a loan, it's not a gift from a family, it's not one of the cultural savings schemes. The lender will want to see that you made your salary, transferred money from your salary into your savings account because you'll need to demonstrate the source of funds. Stable employment contract is required. And what they want to see is, what is your base salary? A lot of people in the skilled worker visa community work in healthcare. So maybe they work for the NHS or they work for a private firm, which means quite often they have an hourly wage or they have a wage that is a base wage, but they tend to do a lot of overtime. When calculating your affordability, the lender's going to want to look at what your guaranteed income is. I also know a lot of people in the skilled worker visa community who have multiple jobs. Make sure if you have more than one job, that your primary employer does not have a clause in the contract that requires permission to work multiple jobs. But let me just tell you right now, if you are on a skilled worker visa and you've been in the country for at least 12 months and you have good credit, you can get a mortgage. I do these mortgages pretty much every day. Make sure you reach out to me. And remember, I'm not here to give financial, legal, or tax advice. I am sharing information that you can speak to a qualified professional who understands your circumstances. But if you're on a skilled worker visa, make sure you reach out, book an appointment, and I'll do a free mortgage capacity report for you. Have you been self-employed for less than 3 years and people have told you you can't get a mortgage? You have to be self-employed for at least 3 years to get a mortgage. It's not true. If you've been self-employed for less than 3 years, I can get you a mortgage. So for newly self-employed people who haven't built 3 years worth of taxes, I can get mortgages for them. So lenders use alternative ways of assessing income, but you want to make sure you have at least 1 year of SA 302 and tax overview. And remember, if it isn't documented, it didn't happen. The income that you report to HMRC is the income that will be used to assess your affordability. It opens doors a lot earlier than with a lot of lenders, in the sense that you may have been told you need 3 years. It's not true. There are lenders who will help you as long as you have at least 1 year and you have a stable income and you can demonstrate that you will continue to make that amount on your first year or more. You may use 1 year's accounts, and it may also include projections. So depending on the field that you work in, you may also be able to use projections or an accountant's reference. These are things that make sure you have a good accountant. And if you're looking to go self-employed and you know that you're going to need a mortgage in the future, these are things that you should discuss with an accountant and a mortgage broker in advance. Don't wait until you've been self-employed for 1 year, knowing that you're going to need a mortgage, to start looking at what the criteria is and who can help you get this mortgage. In some cases, you will need a larger deposit. That will strengthen the application. I'd say you want at least a 10% deposit, and that 10% needs to have been built up in a way that is easily traced and easily confirmed. Clean credit history is going to help tremendously. That's not to say that there aren't specialist lenders who would look at someone that's only been employed for 1 year with 1 year SA 302 and tax overviews that maybe have had some credit bumps, but you'd want to make sure that you've put some distance between you and those bumps before you apply for the mortgage, which is why it's good to speak to me 6 months before you think you're ready, because this way I can give you a blueprint. I can also give you a mortgage capacity report that gives you a step-by-step guide for free on how to get your mortgage. The hidden world of mortgages. Roughly 1 in 5 UK mortgage approvals come from non-standard products, yet banks rarely advertise them and most people just don't understand them. Brokers know where to find these hidden options, and choosing the right one for you could save thousands or even make otherwise impossible purchases achievable, which is why it's essential that you speak with me 6 months before you think you're ready. And here's that offer that I spoke to you about. And it's not a one-time offer. It's not a promotion. It's how we work every day. So we charge you for results. We don't make promises and ask you to pay in advance. The first thing that we'll do for you is a free mortgage capacity report. This is where we'll look at your income, your outgoing, your status, your passport, your credit history, etc. And we'll give you an assessment on how much you should be able to borrow. This is not a credit check and it's not a mortgage application. It's just a conversation where we can answer your questions and give you the answers that you need. There's no broker fee if we don't get you a mortgage. So the way that we work, we do the work first. Once we get to a point where you are happy with the product that we found for you and you decide that you want to move forward, we'll get you an agreement in principle. We'll then charge you the application fee after we've done the work for the agreement in principle. We'll provide full support and guidance throughout the whole process, even after you get the keys to your new property. We're fast and reliable, and you're paying for results. My name is Anthony Lindsay, and if you don't have a mortgage broker and you don't want to take the risk of paying someone in advance for results that you might never get, make sure that you reach out to me. I make these videos to improve your financial literacy. They're not here to give financial or legal advice, and they're not here to give tax advice. But I have written a book called A Mortgage is a Really Big Loan. It's available on Amazon. It's about more than mortgages, it's about finance. So if you're new to the UK or you're a young person and you want to make sure that you have a solid foundation that you can purchase a property in the future, make sure you check it out. It makes a great gift and it's an easy read. I haven't written it with a lot of technical terms in it. I've written it in everyday language based on my 30 years of experience in finance. My name is Anthony Lindsay, and I hope that you've enjoyed this video. I hope that you like, you share, and if you have comments, make comments. If there's a topic that you'd like for me to discuss, put that in the comments. And please make sure you share this video. And even if you've watched just 1 minute of it, please subscribe because that lets the YouTube algorithm know that what I'm doing is valued.